Hey there, everyone. Welcome to the show, the podcast. My name is Jim Kantowski, and I'm joined by my colleague, Jake Sadler in Asheville, North Carolina. And today we are doing the third part of our little Social Security series that we started a couple episodes ago. And we're just going to talk about some additional complications to Social Security. And what we talked about really in the first couple sessions was knowing your benefits, how much you're going to have yourself personally, how to figure that out, how to determine what your benefits are. But then there's all these other factors that come into it, like what are your spousal benefits? What are your widower benefits? What are your divorced spouse benefits? What are the benefits for your children? And so we hit on a lot of those different subjects during our, first episode or second episode around Social Security, probably covered throughout both of them. And so we touched on those, and you can refer to those episodes if you want more information. We touched on when to file, and there's a lot of different things that go on when to file. There's, do you need the money? Do you want to maximize your benefits? Are you still making money? All those sorts of things that we touched on. They're very important. And then a couple things we want to hit on today that we'll dive deeper into, I guess, is earnings restrictions on Social Security. We're going to dive into deeper, a little bit more about taxes on your Social Security benefits. There's also some limitations based on pensions that you or different, maybe a government entity that you work for that could limit your benefits. And then we're going to dig into the challenges of Social Security and sort of what scares people sometimes about it going away or not being there, or just what does it have to overcome, and should we be worried about that? So how did I do, Jake? Did I summarize that okay?
You did. This has been, we've had to break out the Social Security conversation into a few different conversations because it's so broad, it's so deep. There's a lot of complications. I think it's kind of what we're going to get into a little bit more today. Is just kind of like, okay, we peel back some of the layers of this onion. Let's find some more with taxes and government pension offset, this sort of thing, and it's all kind of leading to what probably most folks have top of mind, which are, kind of thinking about the headlines that are out there on the challenges that Social Security is facing with its future funding and its obligations. And so, yeah, let's talk through kind of what that challenge is, and how we're preparing for it in the planning work that we're doing. And, just kind of take a look at some of the ideas that have been proposed for, kind of fixing Social Security, so to speak, propping it up financially. So there are no knowns when it comes to how it might change, but we can at least start to think about some ways that, might be floated out there, some ideas.
Well, let's start with how earnings affect your Social Security benefit.
Yeah. Yeah. So the earnings penalty or earnings test with Social Security. So we mentioned this in our first conversation around Social Security. And the idea of the earnings penalty is this: if you file for your Social Security benefit prior to your full retirement age, so again, that's your designated age, designated by Social Security, that entitles you to your full unreduced benefit amount. If you're born 1960 or later, that's 67. So if you file before that and you have earned income, the Social Security that you have now started to collect may be reduced depending on how much you're earning. So in 2022, the earnings limit was just shy of 20,000. So for the time being, we can at least kind of put that 20,000 mark in our minds for the earnings limit. So if you earn above that threshold, that $20,000, your Social Security benefit is reduced. What you bring home, $1 for every $2 above that limit. So if you earn $30,000, for example, your Social Security income will be reduced by $5,000. So because you earn $10,000 above the, say, $20,000, kind of clean number, limit. So that's how that works. And I do want to point out, because this question does come up, if you are in a married household, if you're kind of married filing joint as a tax filing status, do the earnings of your spouse impact the earnings test for the purpose of what we're talking about, the earnings penalty? And the answer is it depends. But if you're just filing for your own benefit and not claiming a spousal benefit, then your spouse's earnings do not impact the earnings test. So it is an individual test.
And how is that
If
test
you file for
confirmed?
spousal benefit, yeah, so that is confirmed through your tax documents.
So you file your tax documents, and let's say you've been earning too much, the Social Security Administration will reach out to you and say, "Hey, you've been earning too much." Will they ask you for a refund?
Will they ask you for a refund if you have paid? I don't know. It sounds like you might know that answer.
Well, I think what they do is they reduce your benefits going forward.
Yeah, no, it's the following year as far as I know. So, but yeah, they kind of, because sometimes if you file during the year and you've had earnings, then the next year they're going to hit you with that penalty. So, and there is one other kind of little caveat within the little wrinkle within this. In the year that you reach full retirement age, the earnings penalty is $1 for every $3 over the limit, the designated limit, and that limit does go up over time.
So are the benefits gone forever, or do they just take them away for this time period?
Yeah, they just take away for this time period and they get added back, but you don't get like a lump sum check when you reach full retirement age. But it just kind of adds a little bit and, kind of sprinkle on what they reduced over time once you reach your full retirement age.
So in theory, the benefit isn't gone forever. It's just taken away at that point in time, and then your future benefit is adjusted to provide that benefit that you missed out on. That's right. I have that right.
Yeah, that is right. But I think in kind of the way that works, again, you don't get like a lump sum,
Right.
what you had reduced over that period of time. So in terms of what works for your situation, it may make the most sense to just not file if you have earnings that may exceed that limit by a meaningful amount.
Yeah, there's no doubt about it. Like if you think you're going to work and you're going to earn over the limits that you mentioned, then there's really no reason to file for your Social Security benefits, and you should definitely consider waiting. But just as a technical time, it's not gone. Let's say you lost $20,000 in a year, you wouldn't have that $20,000, and they would add it back to your benefit, maybe $1,000 a year for the next 20 years, just as a simple example, something of that nature. So you're not going to have that lump sum. You'll get it paid back over a period of time.
Yeah, that period of time is going to be longer than the period of time for which it was reduced.
Exactly.
So, okay. And I think just the last point to summarize this is once you reach your full retirement age, there is no earnings penalty. That's one of those common misconceptions that's out there. Say you're 68, 69, and, maybe you've left the workforce, but you re-enter and you're doing some consulting, whatever it is. There's a lot of fear, concern. Oh, my Social Security is going to get reduced if I file. No, once you reach full retirement age, you're free and clear of the earnings penalty.
Nice. All right. So we have to look out for the earnings penalty. If you think you're going to earn some money, you're going to work part-time, you just want to consider the levels that you're going to earn and maybe hold off on taking Social Security if you're going to, if you're considering working while you're in retirement prior to your full retirement Social Security age.
Yeah, that's right. And I think just to kind of reiterate my point, because I don't want to leave any hanging, kind of fear or doubt or concern, again, the earnings penalty is based on you as an individual if you're filing for your benefit. But if spousal benefits are part of your calculated benefit amount and you file early, then the earnings of your spouse may it may trigger the earnings penalty. So when you're just filing on your own benefit, the earnings test just applies to you. If you have spousal benefits, your spouse's earnings may impact the earnings penalty.
Awesome. So the next thing I think on our list that complicates Social Security is how it's taxed.
Yeah.
I suppose you want me to answer this.
I do. I do want you to answer this because, it gets a little messy and murky, and let's hear it. How Social Security tax, Jim? Is all of it taxed? Is none of it taxed? How does it work?
Well, it depends on your income, just like those earnings you talked about. And you could have 0% of your Social Security benefits taxed. You could have 50% of your benefits taxed, or the max of your benefits you can have taxed is 85%. So what I mean by that is, let's say your Social Security is $10,000 a year for simple terms, and you are taxed at the maximum level, then 85% of that will be taxed at your ordinary income tax rate. So that $8,500 would go on your tax return as taxable income, which gets taxed as ordinary income. So that is for a single person over $34,000. Your 85% of your benefits are taxed, and over $44,000 for a married filing joint couple, your benefits will be taxed. And to get to those numbers, there's non-taxable interest that's added to the income on your tax return, and also half of your Social Security benefit is included in that amount. So that's why it's complicated, because there's a couple different factors that you have to figure out in there that that will affect how much tax you're paying on your Social Security benefits. So that was a mouthful of it, but it is something that complicates it.
Yeah, no, it gets, you have like a couple of different layers within, okay, is Social Security taxed? Okay, we got good news, bad news. First of all, if your overall earnings are below a certain threshold, hey, none of your Social Security is taxed. If your earnings are above a certain threshold, well, then up to 85% of your Social Security income is taxed. And then the other layer is, in order to calculate that total income, to determine how much of your Social Security is taxable or not, you have to include half of your Social Security income into that calculation. So it gets a little wonky there. But you mentioned the threshold there. So the 0% range, if your overall earnings as a single filer are $25,000 or less, then 0% of your Social Security, none of your Social Security income is going to be taxable income to you. For married filing joint, it's $32,000. I do want to mention an interesting fact here around those threshold numbers. Those threshold numbers were assigned in 1983, and they're not indexed to inflation. So those haven't changed in a long time. And it's kind of one of these kind of like little hidden undercurrents of change that can kind of creep up on taxpayers over time, and you end up kind of paying more and more because Social Security income is going up with cost of living adjustments, if nothing else. So, but that number hasn't been indexed for inflation. Maybe one of those things we talk about later is something that could be changed, but I did want to point that out. And there are some differences in federal and state, which you may have been about to jump to as well.
Well, I wasn't, but we can talk about it. So federal tax is going to apply across the board based on what we discussed, but the state tax rules are actually different. Like here in Maryland, Social Security is excluded from your taxable income up to a certain point. So you wouldn't pay tax from a state tax perspective. I don't know. Do you know in North Carolina whether it's taxable?
It's not. So there are. I'll give you a pop quiz. Do you know how many states tax Social Security? I'll give you. I mean, at least a hint. The majority of states do not tax Social Security at the state level. So we're at least over 25. So how many tax Social Security?
Yeah, so let's go. So we're just over 25. So I'm going to say
less than 25.
Less than 25 tax it.
Yeah.
So how many tax it? I'm going to say 12.
Oh, spot on. You got
it. Yes.
It's 12.
I love it.
Ladies and gentlemen, this was not planned. Jim did not have previous access to this pop quiz.
Thank God you gave me the 25. Otherwise, I would have been nowhere close. So anyways,
I'll just list them here just for folks that are listening. Colorado, Connecticut, Kansas, Minnesota, Missouri, Montana, Nebraska, New Mexico, Rhode Island, Vermont, Utah, and West Virginia are states that may tax Social Security.
Okay. Well, that's good to know. Yeah, definitely. If since we have this national audience out there that we broadcast to, it's helpful to know those different states. But what I was going to get to before you asked that really good question was it's important to understand this tax piece, because a lot of the things we do with our investments, with our IRA distributions, or if we have a pension, or if we work, all these things will factor in to determine how much of your Social Security is taxed. And there's no right or wrong answer on this, But if you pull one lever to minimize taxes, like for example, we do Roth conversions sometimes before you have to start taking your money out of Roth IRAs. And so right now, you don't have to start taking your money out of IRAs till you're 73. So what we do is we start taking it out earlier to take advantage of some lower tax rates. And if you're taking Social Security, that transaction or that conversion of IRA money to Roth IRA money might affect the taxes that you're paying on Social Security. So you could go from paying 0% to paying paying on $0, and then you could go up to paying 85% of your benefits being taxed. So that decision might affect it. So if you're going to be receiving a pension over your life expectancy and you have started that pension, you can just consider your Social Security benefits taxable at the federal level. The other thing that would affect it that you got to be conscious of is investment income. And so a lot of times, you'll have a taxable portfolio, and those taxable portfolios will generate capital gains or ordinary dividends or something, some income, which will create tax on your Social Security benefit. So trying to manage all these things together to try and minimize your taxes is not an easy feat, but it is something you should think about when you're investing and when you're working and when you're taking money out of retirement accounts and when you're deciding whether to take your Social Security benefits early or wait for them.
Yeah, this is really important because the way that, and Jim, you were just describing how Social Security is kind of phased in, so to speak, use kind of the jargon words in terms of the amount that's taxable. This is known, and sometimes you'll see the headlines out there, which can kind of be alarming, calling Social Security a tax torpedo, which is the idea that as you bring in more income into your tax picture, that's going to phase in more of your Social Security and subject it to income tax. And so you can go, if you just look at your kind of federal marginal rate, it's going to be pretty low. Maybe it's hovering around, 10%, for example. And then as you're layering in more income and phasing in more Social Security, your effective tax rate as a result of adding another dollar of income, it might be 18%.
Yep.
Even though you're in like the 10% or 12%. So I think that's just something to keep in mind is kind of the way Social Security is factored in, it's kind of creates this tax torpedo, so to speak. So.
Yeah. And on this next topic, we got to move on, but I just did want to point out too, that your income could also affect how much you're paying for Medicare Part B. Not going to get into that now, but again, it's one of the reasons why you got to factor everything into play. All right. So then you mentioned this government pension offset that you wanted to talk about.
I did want to mention it. So there's a couple little, call them penalties, reductions that are out there for Social Security. If you have been earning in usually a state or local government and are entitled to a pension from that state or local government, and during your employment, your tenure of employment, you are not covered by Social Security. So if you were a state or local government employee, and there's some other categories as well, and you are not paying into Social Security and you're getting a pension from another entity, your Social Security benefit is going to be reduced, essentially. So the WEP is the windfall elimination provision, and the GPO is the government pension offset. So there are kind of more in the weeds calculations on, okay, so say you work 10 years with under, non-covered employment, and then the rest of your earnings history was with, covered employment, you were paying into the system. Then you have to use the calculator tools to determine, okay, what is my actual reduction in Social Security benefits going to be because 10 years of my earnings history were in non-covered employment. So again, state and local government employees not covered by Social Security and getting a pension from those systems may get penalized. The GPO or government pension offset affects spousal benefits. So if you're in a married household and you're the spouse that's working for state or local government entity, not paying into Social Security, non-covered employment, you might think, okay, well, I'm getting my benefit reduced because I was I was in non-covered employment, but my spouse, they were in the private sector and they've got a nice Social Security benefit. I'm just going to claim the spousal benefit on their record. Unfortunately, it doesn't work that way. The GPO or government pension offset kind of eliminates that double dip strategy, if you will, by being able to do that. So if you do have non-covered earnings in your earnings history, it's really important to run those calculators for the windfall elimination provision and the government pension offset.
I've only seen that once or twice. Do you see it often?
No, we don't see it that often. There have been cases where we do see it, and it's kind of unfortunate in a way because a lot of times, and this is kind of some of the difficulties with these particular reductions is that it kind of negatively impacts a lot of really hardworking government employees. Teachers come to mind as folks. They're participating in the system, contributing overall, but not paying into Social Security. They're not covered by Social Security, and so you get your retirement, and that replacement ratio of guaranteed income relative to their working year salary just isn't quite enough. So that's where we see it. Usually, if you do have non-covered earnings prior to 1984, and we're kind of beginning to phase out of that time frame, that's where we were seeing it the most. But there are certain still government entities that are not participating in Social Security, and I know some states, for example, county by county, there may be differences in, say, the school systems as to whether or not the teachers employed there at the county level are participating in Social Security or not. I know some local fire department systems and so forth are non-covered as well. So they're certainly still out there, but we don't see very often.
You got to be a little careful because I think your Social Security state will just provide you the benefit that you're supposed to receive if you've done two different jobs, and they won't say, hey, you're affected necessarily by this until you go receive that benefit. So you sort of have to understand what's going on and whether you worked for one of these organizations or entities to be able to know that yourself, because you wouldn't want to have to rely on that income and then get to this retirement age and say, oh my gosh, this is gone. Is that right?
That's right. And we have certainly seen that in the past where the benefit estimate isn't indicating that there were non-covered earnings, and you have to do the windfall elimination calculation. So you do kind of have to uncover that. I will say in kind of a couple of recent cases we've seen, the employers are being more proactive, I would say, in letting the employees know that they're subject to this.
Okay. All right. Well, thanks for providing some feedback on that topic. A couple other things we want to talk about. This is where our whiteboard could come in handy, or screen sharing. But I think you wanted to, I say you, I'm putting this all on you right now, to talk about how to read a Social Security statement. Is there anything in particular we wanted to talk about there?
Oh, I'll take the heat because this whole Social Security series was my idea. So it would, bit off more than we could chew here. So how to read your benefit estimate statement. That's an important one. I mean, we're talking about kind of in the weeds, all this stuff. So Social Security used to mail this out to everybody. They don't mail it out anymore. They mail it out if you're over 60 or if you call them and request it. But it is available online at ssa.gov. You can establish an account. You have to answer some security questions and so forth to get access to your account. But that's where you download your benefit estimate statement, which will tell you that if you continue to earn at the level that you're earning, here's what your benefit amount would be at all these different ages. So in recent years, the benefit estimate statement format has changed. In some ways for the better, in some ways for the worse. I would say that one way that it has improved is that there's a nice graphic layout for how much your monthly benefit would be and all the different ages between 62 and 70. So that's very informative. Graphically, you can see this difference, the reduction prior to full retirement age or the increases after. The one area where the benefit estimate is now falling short is that it used to include year by year your earnings history. So you could go in there and you could, if you wanted to do your own calculation, say, because the benefit estimate is going to project your benefit based on where your earnings are right now. So if you know that you have a change in income coming up, or you want to plan for a change in income, then you may need to run those numbers yourself for the Social Security calculation. If you're going to do that, you need your full earnings history in order to be able to run the calculation. The old benefit estimate had that. The new one doesn't. It just gives you these time periods. And so you do have to go in and request your full earnings history if you want that. So that's not on there anymore.
But you can see a summary. Hey, this is what you would receive at 62. This is what you receive at your full retirement age. Here's what you receive at age 70. based on current what you're doing and what's going on in your earnings and what historically has happened.
Yes,
And that's pretty easy to find. And it also provides on there, I believe, some disability amounts that you would receive in the event of disability, and survivor benefits are on there.
Survivor so like family, survivor benefits, family benefits are also listed on there. So it'll give you that detail as well.
Perfect. So
it'll also tell you like so if you have enough qualifying quarters.
All right. So pretty self-explanatory. SSA.gov, request your statement, and I think that gets mailed to you. Probably can you view it online? I actually haven't been there in a while.
Yeah, you can view it online. Right. But you can also request that it's mailed to you. And if you can't get access online, you can call and request that a copy be mailed to you.
All right. So moving on from there, sort of this last piece we wanted to touch on is this whole topic of Social Security that we tend to see in the news quite often, especially around election years. And it's something that's in the news currently. And it's like, what changes will be made to Social Security? Will we privatize Social Security? Will we reduce benefits? What changes are we going to make in order to make this thing last? Because as we talked about in one of these episodes, the reason why we're sort of at this shortage, where we have so many more people collecting than contributing, it's creating this shortage. And there's this, when's it supposed to run out?
34. Yeah.
34.
Yeah. And that's, I think such as something to kind of clarify a little bit there. So that's the number that's out there. 2034 is currently the projected year and when Social Security. So right now, we talked about this in kind of that first episode, the Social Security benefits that are being claimed, they're paid from two sources. They're paid from payroll taxes that are currently being collected, but the payroll taxes that are currently being collected aren't enough to pay the bills, so to pay the benefits that are being claimed. Social Security has to tap into their reserve, if you will, their trust fund, so as it's sometimes known, to kind of meet the obligations, the benefits that are being claimed. And so the depletion of the savings account or trust fund, if you will, that's been going on for a while. And it's at 2034 where the trust fund is going to reach the minimum level for short-term financial adequacy. That's the kind of official designation. It's not going to zero. It reaches the minimum level for short-term financial adequacy, which for all intents and purposes is zero in a lot of ways. But it's, it's like something has to change at that point. If nothing changes in 2034, then benefits will only really be paid from payroll tax that's collected. And it's estimated that of the benefits that will be claimed in 2034, only 77% of the benefits that are being claimed will be able to be covered and paid from the payroll taxes that are collected.
So it's covered and paid by the payroll taxes. It doesn't mean they won't be able to fund them in some other way. It's just not from the reserve that Social Security has accumulated, over time by having that surplus.
That's right. So, the long story short, based on this current trajectory, something needs to change in order to be able to pay 100% of the benefits that will be claimed in 2034 and beyond.
You have any ideas how that's going to happen?
There's a lot of ideas out there that have been proposed and floated out there. And I'll just mention, when it comes to kind of facilitating change within Social Security, it has to be passed through Congress. So these decisions immediately take on a political tone, a political element. So there are some relatively straightforward fixes that could address this 2034 solvency issue, one of which is to eliminate what's known as the wage base. So right now, payroll tax is only collected on earnings up to a certain level. And if that level is increased or just eliminated entirely, that would go a long way towards solving for this dilemma. So increasing the wage base is one option. So taxing more of the income that folks are earning. Increasing the tax rate itself is another option. So those all involve kind of directly involve kind of increases in tax. So if you think about the political environment and so forth and trying to get those changes through, I don't think we're looking at a one size fits all solution when it comes to increasing taxes to solve this issue. Maybe, maybe not. But there's some other ways to make this change. One could be raising the retirement age. So it used to be 65, it's 67 now. So we've done this once before. We could do it again, bump it up to 68 or 69 or even 70 for a full retirement age. Some other ideas that are out there, means testing. So as we were talking about the way Social Security is phased in on the tax side, kind of increase that or expand that in a way where if you earn above certain amounts, then even more of your Social Security is taxed, or your benefits are just point blank reduced above a certain level of earnings or household income. And then I think you mentioned one idea to kind of privatize Social Security. So kind of open up the kind of box, if you will, to allow the Social Security funds to be invested more broadly than they currently are, which is in U.S. Treasuries. So kind of expanding the ability for Social Security to manage their resources and invest their resources. So those are all some ideas, increasing the cost of living adjustment or adjusting the cost of living adjustments and how they're calculated. That's another one that's floated out there.
Anything but straightforward, Jake.
Anything but straightforward. And so, as we're talking about this, I think it just, maybe the kind of way to wrap this all up is, okay, we've got these challenges. Here's what we know. 2034 is coming. There's a solvency issue. Okay, how is this going to be addressed? We don't know how this is going to play out. We don't know what changes are going to be made to address this. Hopefully, wait till the very last minute to make these changes, but changes need to be made. So how are we planning and preparing, financial plans, to kind of withstand this uncertainty? And so I'll point to a couple. You may point to a couple as well. I think number one, we will stress test the plans that we're working on for folks. And sometimes we do this by age. So the younger you are, the more we'll stress test the plan, so to speak, for future reductions in Social Security. Some folks, they don't even want to include Social Security in their planning projections at all. Okay, that's fine. It's more conservative. If you have Social Security income, that just makes things look better. We're at least going to do a 25% reduction, I think, across the board if you're younger than 50. So we need to assume that just to manage that uncertainty. If you are already nearing Social Security filing age, generally the expectation is that the current set of rules will be grandfathered in for those that have reached that age. That is how changes in the past have been pushed through. So across the board, and since Social Security's inception, there's been kind of this objective to not penalize those that are already receiving benefits. So we can kind of continue to work with that assumption, but we can also stress test the plan and say, okay, what if Social Security is reduced? What if means testing comes into play and benefits are reduced by 10%? What does that look like? Just to kind of frame that.
Yeah, no, that's a good point. And so I like to think of it as control what you can control. You know your benefits, you know the amounts, and you could either save more, spend less. And so you want to plan around Social Security, which I think can be a really good idea. And if it's there, it's a windfall. One of the things I like to do is Social Security is increased by inflation each year. And so take a very conservative approach to figuring out how much it increases each year as part of the plan. Because if you overestimate the increases, that could overestimate the benefits you're receiving in the future. It's just a different way of looking at what you described by reducing the benefits by a certain percent or, something of that nature. So there's lots of different ways you want to look at it. You just want to make sure you're thoughtful about it. And if you're purely relying on Social Security, you might want to give it a little bit more consideration. If Social Security is a small part of your planning, maybe it's not that big a deal. And if you really have no chance of running out of money, then you probably won't have to worry about it. So anyways, Jake, fantastic points. I think I'm done talking about Social Security. These last 3 episodes, you've worn me out on the Social Security topic. There's a lot to cover
for this year.
Yeah, for this year, there's a lot to cover on Social Security. We never even got into like Medicare care and how your benefits would be affected there. And as always, we've gone over our time. So I'm going to shut us down here today and say goodbye to everybody.
That sounds good. And I think you pointed to our future episode. We're going to do one on Medicare. So that's a good idea.
Can't wait. We're going to get, there's a specialist we're going to get on for Medicare. So we'll do it with
I like that.
All right, buddy. Have a great rest of your day.
Thanks, everybody.
Thanks, everybody. See ya.